Dustin, so good to see you. I'm glad we have time to discuss today the 3 financial planning and investment opportunities in a down market because we're all a little bit scared of the headlines right now. Recently, stocks closed out their worst quarter since 2022. The S&P 500 and the Nasdaq logged their worst performance since Russia invaded Ukraine. Now, before we get into how to take advantage of this down market, I do want to talk through what we're seeing, which is something we've talked about before, concentration risk, which basically means that 80% of the movement that we're seeing in the market right now is due to only 10 stocks. And to put that in a different way for people to make sense of, right now, the Magnificent Seven have lost $2 trillion since the start of the year. This is the S&P's 1-month performance. So Dustin, what are we supposed to keep in mind when we see this much red on the board?
The first thing to keep in mind is, contrary to popular opinion, the S&P 500 is not a well-diversified portfolio.
Right.
It's market weight capitalized. So if you look at that screen, you'll notice that a few of those stocks occupy a lot of the space. Okay, so if everything in your portfolio is an S&P 500 index fund, or if it's a mutual fund, which is benchmarked to the S&P 500, meaning it's going to own a lot of the same stocks and a lot of same weightings, then most of your portfolio is concentrated in 7 to 10 stocks.
Right.
Okay. So you might want to consider including in your portfolio some equally weighted strategies to kind of diversify and dilute that concentration. Especially if you're approaching retirement, you might also want to consider some hedge strategies, and you always want to consider including some negatively correlated strategies in your portfolio, so that you don't get whipsawed violently just by the performance of 7 stocks.
Right. And then you want to talk about 3 other things real quick.
Certainly, yeah. So 3 other things that we would keep in mind is, first of all, don't fear corrections. Okay, corrections happen very often. If we look at this chart of the S&P 500, we can see that the performance of the S&P 500 on an annual basis, most years it's positive. And when we talk about a correction, we're talking about a drawdown of 10% or more.
Yeah.
Understand that a correction of 10% or more on average is something that happens about once a year in the S&P 500. Okay, so corrections happen very frequently, but they're very short-lived, and they happen even in years where we have positive returns. And if we talk about corrections or drawdowns deeper than corrections, so drawdowns of 20% or more is what we would classify as a bear market. Well, if we look at this chart going back to, I believe, the 80s, the blue blocks on that chart represent bull markets.
Wow.
The red blocks on that chart represent bear markets.
Yeah.
So even when we're talking about bear markets, which are scary to a lot of folks, drawdowns of 20% or more, keep in mind that they are very short-lived relative to bull markets. On average, looking at this time period, about 14 months is what we could expect the length of a bear market to be. The third thing that I would tell you to keep in mind is the best days in the market often are grouped very close to the worst days.
Right.
Well, if we just think back a few days to the tariff announcement by President Trump in the Rose Garden, we had 4 very rough trading days with a lot of volatility. And then on the 5th trading day, we had the single largest point gain in the history of the Dow, almost 3,000 points.
Yeah. Dustin, I like to talk to you about these things, especially this visual here, because to see the data, it's so helpful, because I got to say, it doesn't feel that way in my heart when I see those headlines. Those red bars feel so much bigger to me. So let's talk through how we can take advantage of this down market. Number 1, put your cash to work. It may feel like you're making the right decision to hide all your cash in your mattress right now, but that really does compromise your ability to build wealth.
Sure. So if we look at the dividends and the capital gains over time, no single asset class has created more wealth than stocks have. I believe you had a visual for this. Yeah, if we just look at stocks versus cash and bonds, those 2 relatively flat lines, and if we look at that mountain of a line, that's representing the total return with dividends on the S&P 500 over time. So you can see that sitting in cash can be very costly over time. Now that we understand that corrections in bear markets relative to bull markets are relatively short-lived for a long-term investor, if we see a 10 to 20% drawdown in broader market indices, that's a good opportunity often to put some additional funds to work, either by rebalancing our portfolio or if you got cash sitting on the sidelines, putting some of that in the market. Okay.
Mm.
Now, a lot of people want to try to find a bottom, or they want to wait until they feel comfortable re-entering the market. You do that, you're going to miss the opportunity to take advantage of those drawdowns.
Right. Good point. Next, take advantage of your stock losses and consider tax loss harvesting. How does this one work?
So, especially if you get a large taxable account, especially if you're needing to rebalance that account, you might be able to take advantage of take tax advantage of some of your losses by pairing some of the gains in the assets that you need to sell to rebalance that portfolio, by pairing that with a sale of some assets where you have losses. Just understand there are some important rules you need to pay attention to. You can't buy a similar security if you want to realize that tax loss for a period of 30 days.
Mm.
Okay. So make sure you got some professional help if you want to attempt that tax loss harvesting.
Mhm. And then last, explain why a Roth conversion makes more sense in a down market.
So this one's very simple, right? If we've got an account value that is here and we're considering converting some of that account value, any portion of that account value we convert to a Roth, we're going to have to pay taxes on that balance that we convert in a given year. Well, if that account value drops to here and later we expect it to be here, let's go ahead and pay some of the taxes, do some of the conversions now on a reduced account value. We'll pay lower taxes when that account value recovers. All of that difference, those new capital gains are tax-free money. We didn't have to pay taxes on to convert.
Mhm. Yeah, really good point. And then it continues to grow tax-free forever because those accounts don't even have RMDs. But I know that's the topic that we've done many times before, which is also a good reminder, Dustin, for people who are watching us on YouTube. We have such a great library of information on your YouTube page just to send people there. But beyond that, Dustin, if somebody wants to talk through any of these strategies about how they can take advantage of this down market, how can they reach you?
Sure, they can give me a call or a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.